Welcome back, guys, to the second part of this video, structure-based strategy. In this second part, we are going to be focusing on trend continuation, right? I'm going to be talking about trend continuation. If you have not watched the first part, the previous one, just check below this video, you are going to see it. I'm going to attach the link in the description of this very video also, so you can watch it, right? You need to watch it, very, very important. Also, you need to subscribe to this channel because I'm going to do the third part of this video also. All right, so let's get started with this video. If you have not subscribed, subscribe, and if you find value in this video, smash the like button and drop a nice comment in the comment section. Tell me where you're watching from and tell me your thoughts on the video. Let's get started right away. So in this video, we're looking at trend continuation. Two importance include you trade in line with the current trend. That's number one. You are going to be trading in line with the current trend. The trend is already established, you already know it, so we are going to be aligning with that current trend. And secondly, you can add to winning trades because you already have an established trend. These are very important reasons you should trade the trend continuation. All right, so when we are looking at trend continuation, you must understand what we call break of structure, right? You must understand break of structure. There is no trend continuation without break of structure. So for you to say this is a trend continuation, there has to be a break of structure. So we say a break of structure in trading means the price has moved beyond the previous highs or lows, showing that the current trend is likely to continue. All right, so the trend price breaks the previous highs or low. In this case, this is a downtrend, right? So this is the previous low, price comes and breaks it, and that is what we call the break of structure. So here again, this is the previous low. After a pullback, price comes and breaks it again, that is a break of structure. So this is another high, low, price gives a retracement, comes back, breaks it again, it gives another retracement, comes back, breaks the low that it formed before, and then continues going down. This is what we call break of structure. This is the pattern that price gives whenever it is moving, whether up or down, right? And this is that simple market structure that we were taught in the previous video. We talked about lower lows. So this is a low, is a lower low, is a lower low, is a lower low, right? This is a high, lower high, lower high, and lower high, because this is a downtrend. So this is the basics of trend continuation strategy. You have to know this very simple concept of break of structures. Now we have two types of structures. We have the bullish structure and then we have the bearish break of structure, right? The bullish break of structure and the bearish break of structure. In the bullish break of structure, we see that price is actually going upwards, price is increasing, and it is breaking structure to the upside, right? So price gives a low and then a high, it pulls back, giving us a higher low, and it goes and moves above the previous high, right? It increases above the previous high, so it gives us a higher high, right? So that's point where it goes above the previous high is what we call our break of structure. So it gives us a higher high here, comes down, makes a lower a higher low, goes up again, breaks this high, that is the break of structure. Then gives us a new higher high, comes down, gives us a higher low, and then pulls up again, breaks structure again, right? See, so this is it. And now when price is going up, when you are in an uptrend like this, price gives you a high, what we are looking for is where the next low will form, and that is the point where you are expected to buy, right? And then price gives another high, you want to look for where the next low again, the next higher low is going to form. That is where you take your buy again. Just the same thing here. You look for the higher low. When price is in an uptrend, you look for where a higher low is going to be formed, so that you can take your buy position right there. Whenever you see a higher high formed, you have to look for a higher low so that you can take your next trade right there. That is how you trade the trend continuation in the bullish trend. Now the next we have is the bearish trend continuation, right? The bearish break of structure. This is it, bearish break of structure. So price makes a high here and drops, makes a low, right? Then it gives a retracement and forms a lower high. Then comes and goes beyond, falls down beyond the previous low, giving us a lower low. And then pulls back, giving us a lower high. Breaks structure again and give us a lower low. And then pulls back to give a lower high. Then breaks structure again to give a lower low. Now, the way you trade this, just like the previous one, is also by targeting the point where the next high, the lower high, will be created. And this is exactly where the lower high is being created. And that is where you take your sell position. When price forms another lower low, you and starts retracing, start pulling back, you look for a point where you are going to get where the next lower high is going to be printed. So you catch it that point, you take your sell from there, right? So we are going to be studying on how to find the point where this next lows, this next high rather, will be formed, right? Where this lower high will be formed, so that you stay at that point and anticipate the formation of that lower high so that you can sell from there. Now let's see this. So this is basically how it looks on the real chart. Okay, so this is the simple market structure where you have your lower lows and lower highs in the downtrend. So here price pulls back, breaks structure, comes back, retest it, drops again, breaks structure, comes back, retest it. Same thing. This is exactly how it looks on the real chart. See that? So price came here and retested this level. You can see we are able to draw a trend line right there, and that's how it keeps dropping. When it breaks a level, when it breaks a structure, drops, forms a low, which is a lower low, it retraces, gives us this pullback. Retracement, pullback is the same thing. So it goes back to that level where it's broke before, which is considered a support, a support level, turns into resistance. After it is broken, it becomes a resistance, right? It goes to that area, and then within that area, it reverses again and starts dropping. Same thing happens here. Within that area, it reverses and starts dropping. So this is what gives you a clue on how to make your entrance, where to start, where to stay, and wait for price to come so that you can shoot your shot. This is the simple basics of my trading strategy, right? Now, there are 3 best entry strategies I use. Best entry strategies. Number 1 is that I go to lower time frame to look for a change of character, right? Lower time frame change of character. When you go to lower time frame, you look for a change of character. Number 2 is that I look for candlestick patterns. There are candlestick patterns I look out for, and I'm going to teach you that also. And then the third one is I look for chart patterns. Okay, so this is number 1, change of character. And this is exactly what a change of character looks like. So price is coming down right here, drops to this place and makes a low here. Moves back, gives us the retracements, making a lower high. Drops and breaks this structure, making a lower low, right? Then pulls back again to form a lower high here. Drops again, breaks this structure here and forms another lower low, right? Now notice that price has been breaking structure to the downside. All the structures it has been breaking, it has been going to the downside, and it has been forming lower lows and lower highs. It has never formed the higher high and the higher low, right? So at this point, price comes and breaks the structure to the upside. This is also a break of structure, but to the upside, right? It breaks a structure to the upside. Now at this point where it breaks a structure to the upside, we no longer call it a break of structure. Why? I'm going to explain. Calm down, I will explain. Okay, so it breaks a structure here. We no longer call it break of structure. We call it what? Change of character, because it is the first break of structure to the upside. And why we call it a change of character is that this area here, we see that the sellers are the characters in play right here. The people playing at this area is the sellers, right? They are the one playing around this area. They are the one in charge here. But at this point, the sellers get weak and the buyers take over. So the players have changed, right? The characters that are playing right here have changed from the ones playing over here. Here it is the sellers, but here the buyers have taken charge. They are now in charge, they have taken over. So we call it change of character. I hope that is clear. So when price comes back here, this is probably another block. So price taps in there and then starts going up, giving us break of structure to the upside. Okay, so this is a change of character. So when I see that price has returned to my point of interest, as we have here, as when price broke here and returned to this point, what I do is I go down to my lower time frame and look out for a change of character, right? The lower time frame change of character here. Then I will join the trade and start trading from there. Simple. Then the second one is candlestick pattern. Sometimes you might not get this change of character. Price might be sharp that it will not be able to give the change of character. But we are going to see a candlestick pattern like this. It can be a bullish engulfing candlestick pattern or a bearish engulfing candlestick pattern. It can be morning star like this, right? This is a morning star or this evening star. This evening star, you see it, you sell. You see the morning star, you buy. You see the bullish engulfing candlestick pattern, you buy. You see the bearish engulfing, you sell. The next one is the bullish pin bars. You see the bullish pin bars, you buy. You see the bearish pin bars, you sell. So this is also an entry strategy, right? Now the last one, the third one, which is your chart patterns. Look at it. Look at it. You have the continuation chart patterns. There are different chart patterns. You have the reversal chart patterns. We have the bilateral chart patterns. But here we are looking at the continuation chart patterns because we are looking at the continuation strategy, right? So we have the ascending triangle. This is the ascending triangle. So price is in an uptrend already, then it consolidates a little, giving you this triangular pattern, right? Then eventually it breaks it. Then we wait for a retest. As it comes to retest, that's our entry, right? So this is a triangular chart pattern. The next one is the falling wedge. Also, price is in an uptrend, then starts giving this downward consolidation, right? You mark it out, eventually wait for a breakout and a retest, then you enter the trade and you are good, right? Then the next one is the bearish flag. Bearish flag. Now it is called bearish flag because first of all, price is in an uptrend like a pole. We know that when you are drawing a flag, when you have a flag looks like this. You have a pole standing, you have a pole that is standing up very high, right? And then a flag is tied by it somewhere around here. You see a flag tied somewhere around here, right? You see a flag tied to it like this, and that flag usually tilts downward, just as we have here. That flag usually tilts downward and breeze can be blowing it, or it must curve downward. That's why this is called a bearish flag. It doesn't mean that we're in a bearish trend. No, price is on an uptrend. You can see this. This place represents the pole. It's showing you that it is mounting high, right? Price is in an uptrend. So you are trading the continuation to the upside. So a bearish flag is always found in in a bullish market. So you look for a buy, just mark out the flag and then wait for price to break out and retest it, then you buy. Now this is usually for a bullish market, right? Now here, this place is for a bearish market. We have the descending triangle, okay, the opposite of the ascending triangle. Here price is in a bearish trend, and then it gives you this descending triangle, downward triangle. Wait for a breakout and retest, you sell. This one is a rising wedge. You wait for a breakout, just make sure you mark it out. Wait for a breakout, then you sell. Then this one here is a bullish flag, right? It's a bullish flag. Price in a downward trend. You can see this downward line here. A very bearish trend, very bearish move. So price starts retracing backward, starts consolidating upwards like this. Just mark it out, wait for a breakout, wait for a retest, then that's your entry, right? And the retest point, that's your entry, then you sell. Make sure that you target at least 1:2 risk-reward ratio. Don't even if you don't have up to 1:2, 1.5, make sure it's not less than that. In fact, it's not even recommended. I recommend 1:2 risk-reward ratio. That's the most recommended one. Okay, so pause this video and look at these chart patterns properly, master them, go to your charts, look for them, master them, and make use of them. Now finally, and in conclusion, trading is beyond strategy. It is more of mindset and self-control, right? So it is very important to master your strategy, right? Master technicals, master the basics, master all these things, master price action, master market structure, master anything you are mastering. But you see, your mindset, yourself, you must master yourself. You must understand your personality, you must understand your temperament, you must understand your mindset, you must understand how you work, how you behave in different situations, so that you'll be able to control yourself, be able to take appropriate decisions. Okay, and then your mindset, your orientation about trading, you have to get that right. You have to take care of it. If you enter with the wrong orientation, wrong mindset, you're going to have issues. Some people go in with the impression that trading is much like a Ponzi scheme, like a get-rich-quick scheme, like a gambling. So they treat it in that manner, and so they end up having a lot of issues. Okay, so take care of your mindset, read about mindset, and I recommend Trading in the Zone and The Disciplined Trader by Mark Douglas. I recommend it. I think I have it in my Telegram group, so if you have not joined my Telegram group, join immediately. The link is in the description box down below this video. Okay, you can watch, you can listen to it. I posted the audio in my Telegram group. Just go there and listen to the audio. In case you don't have time to read, you listen to the audio, and it will give you everything you know about mindset. Right? Highly recommended. Another thing I recommend is the Candlestick Trading Bible. Very, very vital. Go and read it up. I also have it in my Telegram group, so join my Telegram group and make use of these trading materials. Okay guys, so you can contact me for mentorship, for account management, and for VIP signals. Alright, for robots and for custom indicators. These are tools that will help you to increase your trading result, your profitability, to improve your trading results, right? So this is where we're ending the part 2. Watch out for the third part, and make sure you have watched the first part. The link is in the description box down below this video. I will attach it. Right? Thank you guys for watching. Make sure to like, subscribe, and drop your comments in the comment section. This is the Alpha Trade, and as always, it can only get better. Peace.